Last week's assassination of Qassem Soleimani, the head of the Iranian Revolutionary Guards overseas forces, has reignited tensions in the Middle East and sent tremors through asset markets. The oil price has risen sharply to over $70 a barrel at the time of writing, amid concerns that tensions in the region will impact supply. Meanwhile, the value of assets perceived as safe havens such as gold, the Japanese yen and US Treasuries has also risen. Indeed, the price of gold at one point on Monday hit its highest level since April 2013, $1,580 per troy ounce. It's early days, but so far markets have responded as one might expect if you look at previous bouts of heightened geopolitical risk. Last year our economists published research into the impact of geopolitics on markets. They found that it can significantly impact investment returns and that an active investment approach can help navigate such turbulent times. In summary, how does geopolitical risk affect markets? Geopolitical risk can refer to a wide range of issues, from military conflict to climate change and Brexit. We look at it as the relationships between nations at a political, economic or military level. The risk occurs when there is a threat to the normal relationships between countries or region. Heightened geopolitical risk tends to trigger investors to move away from riskier assets like shares and towards perceived safe assets. This negatively impacts stock market returns, while government bonds benefit, particularly those with short maturities, as they are perceived as the safest. Read more. Outlook 2020, why investors may need to dig a little deeper. The rise of US superstar firms, how will it impact investors? How China's bond markets near a tipping point. Geographically, investors also shift their money away from the perceived riskier regions such as emerging markets and towards developed markets like the US. This is illustrated below by the performance of 4 different assets: US shares, global shares, gold and US government bonds, during 3 major geopolitical events. How did our analysis work? Our economists Keith Wade and Irene Lauro looked at 5 different periods of heightened geopolitical risk since 1985. To do this they used the Geopolitical Risk Index, GPR, which reflects automated text search results of the electronic archives of 11 national and international newspapers. It captures the number of mentions of keywords such as military tensions, wars and terrorist threats. They defined periods of geopolitical risk as whenever that index went above the 100 mark, which you can see below. Our economists created a safe and a risky investment portfolio and compared their performances during these periods. 1. Of course, no investments are truly safe or risk-free. Investment values go up and down and you don't always get back the amount you originally invested. We use the For more on this story, visit the news article link.